Statement of cash flows. The primary purpose of a cash flow statement is to provide relevant information about a company's cash receipts and cash payments that occurred over a period of time. A cash flow statement should explain the change in cash and cash equivalents during the period, which helps investors, creditors, and other stakeholders understand how the company generates and uses cash. The cash flow statement should classify cash receipts and cash payments as resulting from operating, investing, or financing activities and should report the net cash provided or used by those categories. It should also report the net cash of those cash flows on cash and cash equivalents during the period in a manner that reconciles beginning and ending cash and cash equivalents. So there are three main sections. Again, cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. The cash flow statement should be prepared in the following order. You have cash flows from operating activities, then cash flows from investing activities, and then finally cash flows from financing activities, and then the change in cash and cash equivalents, and then the opening cash and cash equivalents balance, and then finally the closing cash and cash equivalents. Some notes. With cash flow from operating activities, this can be prepared using either the direct method or the indirect method. Now, if the direct method is used to report net cash flow from operating activities, then a separate schedule must be provided to reconcile net income with net cash flow from operating activities. If the indirect method is used, then there should be disclosures that contain the amount of interest paid and income tax paid during the period. And any significant non-cash investing and financing activities should be in the disclosures. And a final note, cash flow per share should not be reported. This is not considered a meaningful metric for evaluating a company's liquidity or cash flow performance. We begin with cash flow from operating activities. These include transactions that are related to the primary revenue-producing activities of the company. So cash from customers, cash payments to suppliers, cash payments for operating expenses like wages, rent, utilities, interest paid, taxes paid. Cash flow from operating activities, again, can be presented using the direct method or the indirect method. Simply put, the direct method lists the major classes of gross cash receipts and gross cash payments. It's more informative, but it might be more complex. Conversely, the indirect method just begins with net income. So think net income, indirect. The indirect method starts with net income and then adjusts for changes in non-cash items and working capital. The indirect method is the one that's more commonly used. Now, for a more detailed breakdown on the direct method and the indirect method, I would refer you to the Ninja book. We have all of the T accounts and all of the supporting schedules that you will want to look at. Those aren't really conducive for an audio. You will hate the audio even more than you already do. So we won't go there. Next, we have cash flow from investing activities. These include transactions that are related to long-term assets like property, plant, and equipment, and investments in other companies. So this section of the cash flow statement shows how much a company is investing in the future growth and how it's managing its long-term investments. So property, plant, and equipment. So purchase of property, plant, and equipment. Sale of property, plant, and equipment. Investments in other companies, loans made to other entities, acquisition or disposal of subs or business units. So if a company has a positive net cash flow from investing activities, it might mean that they're selling off assets. Negative cash flow, it might mean that they're investing heavily in its future growth. Finally, cash flow from financing activities. This provides insights into a company's transactions with its owners and creditors, specifically those transactions that affect the equity and the debt of the entity. So issuance of stock, repurchase of stock, issuance of debt like bonds or loans, repayment of debt, payment on dividends. So a positive net cash flow from financing activities might indicate the company is raising more capital than it's paying back. That can be a sign of growth if they're needing that additional funding. Negative cash flow means it's paying down debt and returning money to shareholders through dividends. Real quick, I want to look at a summary of interest and dividends and their treatment on the cash flow statement, because I think some of these items might trip you up on exam day if you're not aware of it or thinking about it. And that's interest paid, dividend paid, interest received, dividend received, and how they're treated on the cash flow statement. Interest paid is from operating activities. Now, you might think, well, that's interest on what you're financing, which is true, but you're financing machinery and things that help you to operate the business. So interest paid is an operating activity. Dividends paid, well, those are financing activities. That makes sense. Interest received, operating. Dividend received, you might think it's investing, but it's not. It's operating. So interest paid, dividend paid, interest received, dividend received are all operating except dividend paid. So interest paid, interest received, and dividend received are all operating. The only one that's financing is dividend paid, and none of them are investing. Finally, I want to point you to a comprehensive example that we have at the end of the cash flow statement, the statement of cash flow section in the Ninja book. And I think it is well worth your time to walk through that and go through the direct method and the indirect method. I think that will be helpful to you. This concludes Statement of Cash Flows.